It looks like the US president's tariff strategy is now clear to everyone. First, he announced them, then negotiations took place, and finally the penalties were temporarily postponed. However, China, as the world's second largest economy, may not fit into this scheme. As for the European Union, it's preparing to use some countermeasures. This means the US dollar and the euro may clash not only in economic terms but also politically. Meanwhile, do not forget to monitor macroeconomic data and how it influences currency trends. You are watching Traders Calendar on February 7 and 9. That day, household spending data in Japan could be the first major market moving factor. For a country that struggled with the deflation dedicated to the last 12 months, have been this turning point. Wages in Japan have barely risen in nearly 30 years, which means a weak yen could not stimulate consumer demand. However, December's figures are expected to push consumer activity, but on a negative zone to plus 1.5. This shift would be positive for the yen and could strengthen its position against the US dollar. The so-called bazooka law that the European Commission plans to introduce may help counter US tariffs, but it's unlikely to support the Eurozone economy. Moreover, the EU risks being flooded with China imports reflected the United States. As a result, Germany's trade balance report could be even worse than the previous one. December forecast suggests that Germany's exports could decline from a 2.1% to minus 0.6% compared to the previous months, and this may have a negative influence on the euro. The same applies to Germany's industrial production report, which shows a decline of over 2% from a plus 1.5% to minus 0.6%. It seems that the recession threat for Germany, like Trump's tariffs, was only postponed temporarily. No, it may return. The employment situation in Canada also looks bleak. In January, the country's labor market could take a significant hit. The number of new jobs is expected to grow by only 25,000, nearly 4 times lower than December's 90,900. Meanwhile, unemployment is projected to rise from a 6.7% to 6.8%, and this could lead to significant losses for the Canadian dollar against the US dollar. Despite the decline in the Canadian dollar, major currencies may show a weaker drop against the US dollar by the end of a Friday session. This could be explained by the US NONFARM payrolls report for January that will be released at the same time. Forecasts suggest the US labor market will begin to cool. The reading is likely to be between 155 and 170,000. Even at the upper limit, this would be significantly below December's reading of 256,000. However, NONFARM payrolls data is collected in the second half of the month after Donald Trump's inauguration and the start of the crackdown on illegal migration. January reports might bring unexpected results. The Fed Reserve closely monitors wage growth. Projections suggest a decline from a 3.9% to 3.8%. For the Fed, this signals a future inflation slowdown, while the US dollar is another reason to weaken. Currency markets may also react to the University of Michigan Consumer Sentiment Index. Published a few hours later, this report could support the greenback. Analysts expect a 0.5-point increase to 73.8 points. Speeches from a top central bank officials are also expected this day. The ECB vice president, along with the two Fed Reserve governors, will share their insights. Such comments often trigger market volatility as they may hint at a future interest rate moves. Please note that the time of all mentioned publications is set in a GMT +3. The next video review of Traders Calendar will be released on a Monday, February 10. And now, we wish you profitable trading. Subscribe to our channel and follow news with us, and see you soon.